what I would say you should measure us on is, well, what happened to NOI during that period? Did we grow that? That's what you can hold us accountable to. But cap rates and valuations, who knows? That's all made up, right? So we can't control that. But what we can control is if we can squeeze NOI out of something, we're doing our job, and then the market's going to do what it's going to do.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Kris Benson is the CIO at Reliant Real Estate Management. They are a top 30 vertically integrated self-storage operator. Kris and his Reliant team have transacted on over $1 billion in self-storage in the past 5 years. Kris, welcome to the show.
Hey, Sam. Pleasure. Appreciate you taking the time.
Hey, man. Thank you for coming on. Certainly appreciate it. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Those 3 questions take longer than 90 seconds to answer. Is that okay?
Do your best.
So where I started, probably very similarly to a lot of people who get involved in real estate. I owned some duplexes in the town that I lived in, and very quickly realized that was going to be very challenging to scale. And essentially, I hated everything about it. It was not really the work; it was more the people. Like, it was just soul sucking. There was always problems. No one was ever happy. So ultimately, I heard in a podcast or read. I wish I could credit who said it to me, but basically, it was big deals and small deals are the same amount of work. You just make less money in small deals. And so we started to scale into some larger multifamily. We ended up building a 64-unit apartment complex. And for me, Sam, that's where kind of the light bulbs went off, where I was like, this is how you make money in real estate. And it was figuring out how to do it at scale. And I'm going to fast forward a lot of the story, but how we got to where we are now is about 6 years ago, I was convinced that cap rates in multifamily couldn't possibly get any more compressed than where they were at that moment. Whoops. I was off by quite a few years. So I started looking for other asset classes to invest in. And that brought me to 2 really interesting niche classes, mobile home parks and storage, and kind of fell in love with the metrics behind storage. So was an investor of Reliant, which is where I am now first. And then the founder of Reliant, Todd Allen, and I kind of formed a partnership, and we've been scaling ever since. So it's been a fun ride.
Man, that's interesting. Your crystal ball was definitely broken when it comes to where multifamily has gone. I forget, I was talking to a friend of mine the other day. They said in 2016 they were underwriting a deal and they couldn't bring themselves to pay $14 million for it. And then it just traded hands at, $45 million here just a couple months ago. And he's just like, I don't even understand this. This is crazy. So, but, aside from that, and some of that, we can get in, I don't want to go down that rabbit hole necessarily and talk about why it's where it is, but you found a niche in self-storage. Tell me a little bit about what you guys are seeing as far as opportunity goes right now in the self-storage space.
Yeah, for sure. I mean, what I would say, Sam, is Reliant is a value add shop. So generally we're buying existing assets and adding something to them to force appreciation. So our goal is always to grow NOI. And usually our plan is expansion. So we're adding square footage and then getting those units leased up. And generally that's where we're getting our NOI growth. We do some other things, especially if we're taking over kind of a mom and pop owned facility, there's usually some low hanging fruit there, as far as, rental rate increases and having things like U-Haul truck rental and tenant insurance and those kinds of things as well, where we can add some ancillary income. But I would say, look, the market in self-storage in the last 3 years has been pretty incredible. We've seen a significant compression in cap rates, right? So values have gone through the roof. And what's interesting, Sam, as we stand here today, it's the middle of June. Interest rates are rising, but we haven't seen cap rates come up. Values are not changing yet. Mm-hmm. And I think, a motivator behind that is there's still a lot of capital chasing deals from an institutional level. Right. There's a lot of money still trying to get into the asset class. I had a call this morning with a group. They just funded a group that is starting up and looking for some expansion capital. And they had 13 term sheets. And this group is coming to us saying, hey, these guys are still looking for a place to place money. Do you want to talk about it? So there's still a lot of capital chasing this asset class for the reasons that, we fell in love with it. There's a lot of recession resiliency there, at least in the last 2 economic cycles. And I think, institutional capital is trying to find a deployment in that space.
Yeah, I mean, certainly, I don't know. I don't know any asset class where capital just isn't chasing yield. I mean, it's looking for it wherever it can find it. So, it's obviously no surprise that it's gone into self storage. But let me ask you this: I understand and we think we well covered it on this show, the recession benefits of self storage. But yet, I think in every crisis, it brings out unique opportunities to acquire. Are there people who are misaligning their portfolios or taking on debt in the wrong way or just setting themselves up for failure in the self-storage asset class in particular if we go into a recession?
I hope so. Time will tell, Sam, right? I agree. Usually the best buying opportunities are going to be in when there's blood in the streets, right? And
right.
We'll find out is there's been a huge glut of self-storage development in the last 5 years, right? So a lot of people, when you make money in an asset class, people are going to show up and say, oh, I can do that, right? So there's been a lot of merchant builders who are not self-storage operators. They just are developers, right? They can develop a storage facility and they hope, hey, on the back end, I'm going to sell this to one of the REITs or a publicly traded company. It's going to turn out just fine. And they've been right for a long time. The interesting part is going to be, look, if I did a ground up development 3 years ago, I was probably underrating sub 4% debt on my construction loans, right?
Right.
In my model, I was saying, all right, it's going to be a year plus to build. It's going to take me a year or two to lease this thing up. And then I got to go get perm financing. The question is going to be, what did they underwrite that permanent financing at interest rate wise, right? And if they needed it to be a 4.5 to make their project work, well, they're going to come into a market where it's 5+, right? And that's where we could see some pain, right? Is these C of O deals where they're coming to market and saying, all right, I got to go get perm financing. And the lender's looking at them saying, yeah, at 5.5, or you can buy down your note. You got to come up with a big chunk of cash to buy down the proceeds. So Sam, I think, for those operators that may not be well capitalized, there may be some opportunities there where deals come that either banks are taking or banks are starting to shop because they know, hey, we're going to get this thing back. So, I think time will tell. The other part of this is there's a lot of people in the space who, are not sophisticated operators. And when things get tight, again, it probably comes down to bad debt or too aggressive on the debt side. But when you're not a sophisticated operator, it's harder to make things work when, the revenue side gets a little bit tighter.
What are some things, when you say that word sophisticated, what are some things that come to mind that you would say would make someone a sophisticated operator?
Yeah, that's a fair question. I mean, there's a lot to that, right? And I think it depends on what you're thinking about. But let's start with just kind of the digital marketing side, right? And how you're attracting customers. I think in the world we live in, Sam, today, even in the smaller markets, the secondary and tertiary markets, we generally like to operate in the smaller markets because we have a competitive advantage there, right? Our digital ads, Google AdWords, SEO, those types of things. Generally, mom and pop operators have a website, but they're not really doing anything else, right? And when I say mom and pop, it's not derogatory. People who own less than 5 facilities kind of fall in that category, right? Sure. And it's not good or bad. It just is. How they attract customers. Do they have, I'd say a big thing in the last 24 months have been touchless leasing, right? So the ability for a customer to rent online, get access to their unit, get their lock, and never go in the office, sign their lease, everything is done online. That's, since COVID, has been a huge push. I would say probably 30 to 40% of our leases, they never walk into our facilities.
Right.
That's another one. And then I would say this one is probably going to be most important moving forward, is kind of a dynamic pricing algorithm where you're matching prices day to day based on occupancy and trying to squeeze out revenue based on, hey, we may have 5 to 7 types of units in a particular facility, and each one is being priced based on that type of units occupancy, right? So if 10 by 10s are full, that price is going to go up. If 5 by 10s are, empty, that price is going to go down. And that's shifting every day comparatively to what's happening in the rest of the market. So just kind of a snapshot.
No, I love that. And that brings, a few things out that maybe, hadn't thought about. And we're certainly seeing that on the dynamic pricing side on the RV resorts. It's something where, again, mostly mom and pop owned. And it's like, well, we know that, it's, $69 a night, $79 a night, whatever it is. And that's been what they've been saying for a decade because it's easy to remember. but it's also terrible for business. Like, wait, no, I mean, it's July 4th. You should not be 79. You should be $179 a night, like whatever it is. Again, I'm making up numbers here, but that whole dynamic pricing capacity is something that it's overlooked, I think, in a lot of industries. And we've seen that, of course, come around in Airbnb. We've seen it, the airlines, the hotels have had it forever. And it's like, why don't we have this applied across, all of our real estate asset classes? So I think that's, do you think that will take off? And this is a random stray thought here, so forgive me. I mean, we haven't seen that in the multifamily space yet.
The dynamic pricing?
Yeah. Have you seen that anywhere?
Yeah, it exists for sure. Especially some of the larger operating platforms. That's where I first got introduced to it, is that pricing is changing in the market almost daily based on unit type. The difference is, Sam, with multifamily specifically, right? The big boys report. So there's, like the Yardi and the CoStars are getting that data so that everybody can have the benefit of having that data, right? And in storage, there's a couple groups trying. Radius is one where they're trying to create this momentum where operators are reporting this information in so we can all benefit from it. But it's definitely not to the level of like a multifamily. And part of it is just because the market is much smaller than multifamily. So software companies are looking, hey, where do we invest dollars to build a platform? Storage is a smaller addressable market than multifamily, right? So I think part of it is who's making investments into the space, and storage has come a long way from where it was 10 years ago, for sure, in the sophistication and, the technology that's supporting it, but it's still not to kind of the maturity level, I would say, of like a multifamily or an office, right? Some of the core four when you think about the major real estate asset classes. But yeah, I would say that pricing algorithm tool is super helpful when you think about how to squeeze NOI, right? And Sam, in the world you and I live in, that's how we should be judged by investors, right? So if you have been an operator of almost any asset class for the last 5 years, you should have made money. Unless you're really, really screwed it up, you should have made money. And that could have been just cap rate compression. You could have done nothing and you still should have made money. What I would say you should measure us on is, well, what happened to NOI during that period? Did we grow that? That's what you can hold us accountable to. But cap rates and valuations, who knows? That's all made up, right? So we can't control that. But what we can control is if we can squeeze NOI out of something, we're doing our job, and then the market's going to do what it's going to do.
Right. Absolutely. Absolutely. Tell me about this. You guys, you own some regular, just standard self-storage. When I say that, I'm thinking like you said, 5 by 10, 10 by 10, whatever, 10 by 20 units. Do you guys have your hands in any other type of storage? Like
wine storage or like that type of stuff, or boat and RV?
Yeah. Any of those. Those are not, I hadn't thought about wine storage, but yeah, are those, do you guys, I guess obviously you own boat and RV storage as well. Is that right?
Yep, we do. We have some boat and RV specific facilities where that's all they do. And then we also have some storage facilities with traditional climate, non-climate controlled units, like everybody knows, like the garages that we have parking on. Sometimes it's, covered parking where you got the steel beams, corrugated metal roofs, and trickle chargers, and you can park in there. We kind of have a mix of both. It really depends on the market that we're in. Where we found the most success, obviously, in the boat and RV parking is somewhere around a lake or a recreational area. Generally, people want to park their boats and RVs there. So yeah, it's very market specific. If we're, in downtown Atlanta, does a boat and RV parking place do well? Probably not.
Probably not. Or conversely, an RV parking place in downtown Atlanta might do great. Just in the sense that
that's fair.
Where else are they going to park it? Like, you can't park it in your street, in the neighborhood. Your HOAs forbid it. So it's going to be, where else are you going to put an RV if you own one? Yeah, that's interesting. I know we talked about that a little bit off air, as to like what happens to all of these assets, if we have a recession in the gas prices. Gas prices keep going up. We go into a recession. What happens to boat and RV storage? Where does that go? I don't know.
Yeah, it's going to be interesting. Last night I was cooking dinner actually, and I had the David Muir nightly news, ABC or CBS. I don't know what channel it is, but
no idea.
Talking about Biden, potentially proposing the idea of a gas tax holiday. And I was like, oh, that's probably a good idea right now. And then they're like, that will save on average 18 cents a gallon. I was like, Perfect. That should make a huge impact in most people's lives. They fill up 10 gallons. I get $1.80 back. Thanks, federal government. I guess I don't know how you kind of think about that and be like, that's how we're going to fix this.
Right. Let's not think about the fact that it's 3 times more expensive to fill up this year than it was last year. Let's think about saving 18 cents a gallon. Yeah, absolutely, man. It'll be interesting to see how that shakes out. There was a conversation we talked about again before we hit record on this, where you were talking about return on equity. I thought that was an interesting point where you were talking to a seller, and the sellers, you basically were able to present to them this idea that, hey, you can hold this asset for a decade, but what's your equity doing for you? Can you break that down for us? Because I really like that thought process.
Yeah, for sure. I mean, look, I'm a huge believer, Sam, that real estate, anything you buy today in 20 years is going to be a good deal, right? So I'm 42. Anything that I had purchased when I was 22, today it's worth more money,
for sure,
unquestionably.
Right.
So, what I think about that's kind of on my original invested equity, I may have an incredible return on that when and if I have a liquidation event, right? So let's say I hold it for 20 years. But if 3 years in, the equity in the deal has doubled or tripled or quadrupled or whatever, the specific situation you and I were talking about is a gentleman who built a boat and RV parking facility, and he had 10x'd essentially his equity by building the facility and filling it up in 2 years. And so what I think about from the investing side in that is, okay, so you have X amount of equity. What's your return on the equity that you currently have? Not what he wrote the check for, right? He wrote the check for 250 grand when he built it. Now he's got 2.5 million in it. And when you look at your cash flows, not on 250 grand, it's your cash flows divided by 2.5 million. His return on equity is terrible. And not terrible, but there are other opportunities for you out there. And so I think that's how we look at a lot of our deals with our investors is when we get to that point where there's equity in the deals, is it time to liquidate or refinance and pull that equity out? Because our investors' money has built that equity too. And we Reliant with our equity in the deal, don't want it sitting there not earning. And you as an investor with Reliant, if you've doubled your equity, you don't want that sitting in there getting a 2-3%, especially in this inflationary environment, right? So I think it's always just a balance of, you got to look at, all right, what can I do with this money if I pull it out? And if I'm going and buying boats and RVs, probably not a great investment. But if I can pull that money out and go reinvest and churn it again, that's where we start to get that compounding effect on the investment side of things.
Yeah, and I think that's obviously that doesn't bode well with the Dave Ramsey school of thought, but it's I think there's differences there obviously between what he talks about, like you said, hey, if you're going to pull out this equity and go buy a boat just for kicks and giggles, then you're just buying another highly depreciating asset and paying probably too much for it, and that's a bad move. And I think that's always a personal decision too. Like, sometimes there's a return on equity and then there's a return on peace of mind, and it's like, okay, well, which one is it? Maybe this guy's super happy. He's like, I don't care, man. I own a facility free and clear, and I get paid for it every year, and I don't have to think about it. So ROPM, return on peace of mind? You don't know, but I do like that idea.
You should trademark that, Sam. ROPM,
return on peace of mind. And so I think that's always interesting as we survey our own portfolios and go, okay, what's it look like to extract maximum value and maximum return out of this? And do it in a way that is meaningful and also, protects us from downside risk. Are you guys doing any development right now?
Yeah. You're saying from a ground up standpoint?
Yep.
Yeah, we are not what I would consider a developer, meaning, hey, we can do 10 projects a year. We just don't have the team to support it. We are in the midst of, 2 active developments, third that's kind of going through an approval process right now. And hopefully we'll have shovels in the ground before the end of the summer. So a little bit. Generally, we're usually about 1 a year. But what I would say is there's going to be value in development right now, and there has been. But we feel like there's kind of an interesting space right now, just from a return on stabilized yield, like what you're going to get once this thing is built, and the prices per square foot that are being paid for basically empty buildings and the replacement cost against it. There's a delta there and an opportunity for sure.
Right. Yeah, it's really interesting. And that's what we're seeing a lot, even especially in the multifamily space. I have a lot of people come on the show and say that. They'll say, hey, it's cheaper for us to build than it is to to buy existing and then do a value add. Like we can just turn around, just put a shovel in the ground, start ground up, and have a better product for less money. Like, well, that's really interesting.
For sure.
Fantastic. Kris, I really enjoyed this. Thanks for taking the time today to break down the self-storage market for us, what you guys are buying, how you've bought it. I love the clarification there around what a sophisticated operation or operator could look like, and kind of giving some quick ideas on, when you see a mom and pop operator, the things that could be very, very easily improved. Certainly appreciate that. Thanks for taking the time to share your story and just give us insight on what opportunities you see out there in the market. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Yeah, I think probably our website's best, reliant-mgmt.com, which is the abbreviation of management. Or if you just Google Reliant Real Estate Management, you're going to find us. You can find our current investment opportunities, contact us, get in touch with our team, and learn a little bit more about the team and track record here.
Awesome. Kris, thank you again. Certainly appreciate your time.
My pleasure. Thanks, Sam.